Happy Monday, everybody. Today is January 26, 2026, and this is your Monday market update. Markets returned from the long holiday weekend last week to a surge in headlines, sharp swings in sentiment, and a reminder of just how quickly confidence can be tested and restored. It was a shortened week, but it was packed with just about everything investors have been navigating lately. That's geopolitics, it's rates, policy uncertainty, and the market's ability to recalibrate once the noise fades. Back to the markets. Let's walk through last week, then we'll talk about this week ahead. Markets reopened on Tuesday under immediate pressure. Stocks gapped lower at the open as geopolitical tensions surrounding Greenland escalated over the weekend with renewed tariff threats aimed at several European nations that reignited trade war concerns almost instantly. At the same time, global bond markets were under stress, particularly in Japan, where a sharp rise in government bond yields forced global investors to raise cash. That combination pushed yields higher worldwide and created a classic risk-off environment. The S&P tried to stabilize mid-morning near late December support, but weak treasury auctions and intensifying political rhetoric erased those gains. Stocks slid steadily through the afternoon as investors repriced higher for longer rate risks and growing policy uncertainty. The Dow was down just under 2%, S&P 500 down about 2%, and the Nasdaq was down just a little bit more than 2%. On Wednesday, markets attempted to steady themselves, and by the end of the day, they did more than that. Stocks opened sharply higher after remarks from President Trump at the World Economic Forum in Davos took military action off the table in the Greenland situation. That removed that worst case scenario and allowed investors to re-engage with risk. Midday headlines briefly disrupted the rebound, but the tone shifted again in the afternoon following strong treasury auctions and confirmation of a framework for future negotiations between the U.S. and Europe, along with confirmation that no new tariffs would take effect on February 1st. That had been previously announced. That late-day clarity sparked a broad rally into the close. It was a good example of something we discussed in Friday's planning video. Markets often react first and ask questions later. When uncertainty eases, prices tend to normalize quickly, and investors who already have a plan, they don't feel pressured to act in the middle of the storm. The Dow was up a little more than 1%, S&P up just over 1%, and the Nasdaq was up a little bit more than 1%. Thursday built on that momentum, but the tone was more measured. Stocks opened higher again as geopolitical tensions continued to cool, but stronger than expected economic data pushed treasury yields higher early in the session, limiting the upside. Jobless claims remained historically low, GDP was revised slightly higher, and inflation data came in warmer than expected, reminding markets that growth remains firm and the Fed may not be in a rush to cut rates. Now, despite the data, yields held steady later in the day, and the market stabilized near the key technical levels. Stocks bounced modestly into the close as investors weighed solid fundamentals against lingering policy uncertainty. The Dow was up roughly 2/3 of 1%, S&P up about half of 1%, the Nasdaq was up just under 1%. Friday was a quieter and more reflective day. Markets opened higher, but spent most of the session digesting the week's rapid swings. Technology stocks continue to show relative strength, while financials lagged amid rate uncertainty and mixed earnings reactions. Under the surface, investors remained cautious, but there was no broad sense of panic. The week itself reinforced the core message from Friday's planning video: planning for change before change forces the plan. That's the idea. Sharp moves driven by headlines can feel unsettling in real time, but they don't require new strategy. They test the existing ones. The Dow was down a little bit more than 0.5%. S&P 500 essentially flat on the day, and the Nasdaq was up just under 1%. For the week, the U.S. markets finished slightly lower in a holiday-shortened stretch marked by volatility and rapid reversals. Early losses driven by geopolitical fears were partially offset by a midweek rebound as the rhetoric cooled and fundamentals reasserted themselves. Beneath the surface, leadership broadened modestly, with energy and materials showing strength while financials lagged. The bigger takeaway wasn't about any single headline. It was about market resilience. Markets absorbed a lot of uncertainty and still found their footing. This coming week brings several potential catalysts. The Federal Reserve does take center stage again with its first rate decision of 2026 on Wednesday, where no change is expected, but language will matter. The meeting is likely to be relatively uneventful, with only minor adjustments to the policy statement. Chair Powell is expected to emphasize that the Fed has already delivered multiple rate cuts and is now well positioned to pause and assess their impact on the economy, reinforcing that wait and see posture rather than signaling urgency in either direction. From an economic standpoint, the week starts with durable goods orders today, where economists expect a strong rebound driven largely by aircraft orders, while underlying business investments trends remain steady. Consumer confidence and home price data follow tomorrow, offering a read on household sentiment and housing momentum. Later in the week, attention shifts back to inflation and the labor markets. Jobless claims are expected to remain historically low, reinforcing labor market resilience. Friday's producer price index will be closely watched, with forecasts pointing to modest, controlled inflation pressures, consistent with a stable but still run hot economic environment. In short, the data seems to continue to support a narrative of solid growth, moderating but not vanishing inflation, and a Fed that can't afford patience. Layer on top of that will be a heavy earnings calendar. That's a big one, with Microsoft, Meta, Tesla, and Apple reporting results, keeping the market focused on margins, demand trends, and AI-related capital spending. It's not just going to be AI and tech, though. Over 20% of the S&P 500 are going to report this week, so a lot can happen on that earnings side. As always, the market will be balancing strong growth with policy uncertainty, a familiar theme. The goal is not to predict every headline, it's to stay disciplined when they arrive. For now, have a great week and stay warm.